Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, a European rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Before getting into the discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. All right, we're recording this on Thursday, straight after the ECB meeting, literally hot off the press. So without further ado, let's talk to you, Giles, and well, let's just go through the meeting, I suppose. Was it as you were expecting? You know, we talked last week about base case expectations. Did they deliver on those?
Yes, depressingly, it was pretty much exactly as we were expecting, I think. And perhaps the problem here is that it was as many were expecting. So, I think the bottom line was they played it very, very straight. I mean, the main thing that we were looking for, of course, was this change to the language around PEPP. Previously, they had said, in fact, for the last 6 months, they've been saying that they were going to conduct PEPP at a significantly increased pace compared to the first few months of this year. Okay, so they've taken that out and they've said they've actually gone a little bit further than we thought. We thought that they might just take that out. Well, you have to get down to the actual language of these things. I mean, that's what often matters in these kinds of statements. They said that they would conduct purchases at a moderately lower pace compared to the previous 2 quarters. So what does that mean? Well, it's up to interpretation, to be honest with you. Our best guess is that, maybe it means that they're going to be doing maybe sort of 10 billion-ish, maybe a little bit more, depending on how things go in the markets and what the data is telling them that they ought to be trying to do, really. What should they be pursuing? So a lot's left open to the imagination, I think, around that. But roughly speaking, I think it was in line with what markets expected. And look, we've had a very small rally, as I guess markets just kind of you never know whether it's going to go like this, but this idea of buying the rumor, selling the fact, that's often the way that markets trade, and that seems to be the way that it's reacted this time around too.
I guess the other big thing that we were looking for, or the other change that we were looking for in the meeting, was around the macro projections. What was her kind of assessment of the risks, and how does that compare to what we're thinking about the outlook for the next sort of year and beyond?
They were cautious, right? They have been raising their forecasts all year because I suppose the downside risks haven't been materializing at the rate which, ex ante, it wasn't obvious that they would. So, this year has overall been a story of positive surprises on the growth side, and depending on your outlook, positive surprises on inflation as well. Certainly, higher than expected inflation. I'd say, we'll have to go back through the text more carefully, but my overriding impression was that the assessment of risks was pretty balanced, but within that, relatively optimistic, because Lagarde seemed to be going out of her way really to kind of just acknowledge the perhaps slightly all these risks that are probably relatively even very low probability, but potentially catastrophic. And we're not, I guess, at a stage where you just want to sort of ignore them completely, right? So that seemed to be the way that they were going. So I would say that there's quite a bit of scope here, assuming those don't, this kind of overall improvement continues, and in particular the COVID risks, the COVID related ones, don't materialize. And that's absolutely our base case. We've talked at great length on this podcast about how Europe is now the best protected region in the world, really, when it comes to these sorts of risks. So we don't think that's going to become a big issue, and there could be a reasonably significant revision again to these forecasts and the risk assessment by the time they come back to all of this in December. And that was the other sort of key message from today, that December is really going to be the next decision point. Don't expect much from them in between.
Yeah, I guess just to add on to that forecast as well, they revised up their 2021 forecast for this year to 5%, which is below NatWest Markets base case of 5.2, but that doesn't include the better data that we had this week and the revisions that came to past data as well, because obviously that's beyond their cutoff. So even without her, I guess, more positive skew of risks, even though she said they were broadly balanced, there's kind of a natural upside to those forecasts when we get a refresh in December.
Yeah, but I mean, perhaps that's what I should have said. It's almost as if you had an answer in mind, Imogen.
Never. Right. Combined, we get the perfect answer. All right, then. I guess that's all we need to say really on the ECB, isn't it? As expected, and come back in December pretty much. So perhaps not the quiet December that we were hoping for. Well, at least until the 16th anyway.
I don't want a quiet December. I want something to happen.
All right, fair enough. Jan, then over to you, because since we last caught up, it feels like a while ago now, but actually we haven't discussed the weaker than expected payrolls number on last Friday, which obviously came, well, for us on Friday afternoon, and then the US was out on Monday. So the market hasn't had that long to digest it, and we haven't heard much from Fed speakers since then. So I still think it's worth discussing on this podcast. What was our take then on that weaker than expected number, and how does that change our outlook, or not at all?
Well, I mean, it is hard to argue that the last jobs number that we got was pretty weak. I mean, by any measures, it was a sharp drop from the previous couple. But the question now comes down to whether the markets are going to look at this as like a kind of one-off event that was like an aberration, or is it the start of a new trend? We certainly don't think it's the start of a new trend, but more likely and hopefully we'll see a rebound instead. But it doesn't change our base case by, well, we still stick to our base case of, like for the taper timeline, November announcement, December start. But I think what this implies is that the September Fed meeting will not be as eventful, not necessarily as eventful, but less of a risk event on both, like from a signaling point and from the dots. But on the other hand, the next NFP, the next jobs number that we're going to get, I believe it's on October 8th, will be very, very important. And again, this ties back to from an inflation point, that we have cleared that hurdle, but from an employment side, there is still more progress to be made. Circles back to the substantial progress, which is, I guess, tied to the employment.
So, as I said, we didn't hear from any Fed speakers on Friday when the data came out, and then it was a holiday in the US on Monday. So we've really not had much to go on in terms of Fed policy, but we did have Williams on yesterday. Just getting my days mixed up. What was your assessment of his outlook? Was he more dovish than you were expecting, or pretty much in line given the data on Friday?
Yeah, going into his speech, and I have to admit I expected it to be a little bit more of a risk event in this relatively short week, but it was a more dovish on balance than what I would expect. It's hard to deny that. He certainly did echo Chairman Powell's speech at Jackson Hole, from the need for more progress, from there's a lot more to do, and the slowdown by COVID. He did say that tapering might be appropriate to start this year, but the hurdle from a labor market perspective has not been met yet. So that but element adds a little bit more dovishness. Again, circles back to what is the substantial progress? When are we gonna reach it? Again, makes the October jobs number very, very important. He did say that more gains are needed. So if we get another, say, like an exceptional, or hopefully an exceptional number, I think we're pretty much back on track. He didn't necessarily comment that much on the NFP print specifically with going details. He did say that he acknowledged a slowdown, but he did say, of course, it was due to COVID-related slowdown, and that isn't really surprising. I mean, the Delta variant has been the number one risk factor on the Fed's dashboard for quite some time. And one more thing that is worth mentioning from that speech that I think has gives another subtle hint towards the modalities of the tapering process. He did say that there's a lot more than Fed's actions that are driving housing prices up. So that kind of goes with the view that MBS purchases are not the first order of driver for the housing prices. Maybe not even like a second order. You know, it does contribute, but not as much as it's widely perceived. I mean, minutes had the minutes for the previous meeting had all but confirmed, but I think this definitely points in the direction that purchases, when tapering starts, the tapering is likely to be equally weighted across mortgage-backed securities and treasuries rather than overweight in mortgage-backed securities. So to summarize, it was a dovish speech, and it did echo Chairman Powell, but I think now the focus will be on the next jobs report, and this speech kind of confirmed that view.
So you're looking ahead kind of to the October jobs report and beyond the September FOMC then, in your opinion, does the kind of news that we've had over the last week really no longer make the September FOMC a live meeting, and it's all probably about the November meeting after that? Is there a November meeting? October meeting. The meeting after the October jobs report. And I can see Giles laughing because someone else made exactly that mistake live on the ECB press conference earlier. So I'm happy to follow in their footsteps.
So, I mean, again, I don't want to say anything about not being live meetings. It will be close to watch, but we do expect an announcement in November for the tapering to start. And unless we get like an extremely weak jobs number in October, I think we're pretty much on track for that.
All right, sounds good. So on track for a November announcement, December taper, and all eyes on the October meeting. So it's all about the jobs report in October and the ECB meeting in December. From here then, there are risk events to watch, and a few things in between them, but for monetary policy. All right, guys, thank you very much for joining me today. I'd just like to remind our listeners that if they like today's episode, then please hit the like button to show your appreciation and click subscribe so you can listen to our latest episodes as soon as they're available. Thanks. See you again next week.